Well, hello everyone and welcome. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar where we'll be discussing crude oil supply and demand and their impact on crude oil prices. Now with us today, I'm very pleased to have Joel Fingerman, who is the Managing Director for Fundamental Analytics. Now we'll also put his disclosures up while I pass Joel those controls. And Joel, in just a moment, let me pass you the presenter controls. If you would go ahead and select Show My Desktop, we'll get underway here this afternoon. Thanks for joining us, Joel. Take it away.
Thank you.
Oh, we see your screen? Beautiful.
Good. Thank you. What I want to talk about today is the domestic, primarily U.S. domestic, crude oil supply and demand issues because of the impact of the COVID-19 on the economic issues and the oil demand issues. And what we have here is a series of charts that we follow of the supply and demand issues that are released by the EIA every Wednesday morning, if there's not a holiday, at 10:30 Eastern Time. We grab these numbers, and within seconds, all our charts are available and updated for this information. And what I have here is, as you see, a whole series of tabs of information that I've set up, but you can also have this set up on your system if you're using the platform very easily. What we're seeing now is that as of this morning's announcement, the crude oil inventories were increased slightly, and we're now sitting at about 1.2 million barrels, and we're sitting now at roughly 536 million barrels of crude oil in inventory. We've seen this number grow because of the lack of demand. I can look at this from a perspective of this year-on-year overlay chart, where this I highlight on the bottom. I can see the current year or what happened last year at the same time, or 2 years back, or so on. I'm showing 5 years worth of data. Our system allows you to see up to 15, 20 years worth of data, should you like to see that. If we want to look at this from a time series perspective, we go here and we click on time series, and we see this then as a time series perspective of the same data. Let's change something here a little bit. So we have an overwhelming amount of crude oil stocks, which is depressing prices right now with that supply. Now, related to that then is what, besides looking at the crude oil, but what is affecting that obviously would be gasoline demand, gasoline and the distillate fuels and other fuels which are made from the crude oil. So as a quick review, we look at the stocks of gasoline, and we see that again, unusual amounts of oversupply of gasoline stocks. It's come down a bit, but again, compared to last year at this time, it's significantly above. That's because driving has not come back from the normal levels, where roughly 80% of driving use is for going to work, and with that, the orders to stay at place and shutting down various businesses, we're not seeing the demand for driving to work as much. And again, from a time series perspective, we see here that the gasoline supply is very strong. Similarly, what's very interesting is the distillate stocks, which are huge relative to their and aseasonal. Usually at this time of the year, distillate stocks are drawing into the lows into the summer, but what we've seen is at the beginning of the closing down of industry, manufacturing, and other demand, we see the stocks have been growing dramatically during this period, which is pressuring distillate prices, which in turn will pressure crude oil prices, what they're made from. And again, from a time series perspective, we can look at it this way, that we see that the stocks relative to previous times is at a huge availability, much more than we've seen before. So we have large inventories of gasoline, distillate, and the crude oil for the raw material. If we look at the production numbers, what has happened, though, is that the production has dropped dramatically in these last few weeks because of the lack of demand for it. And so we have a plot here of the crude oil production numbers, and we're seeing it used to be as high as 13 million barrels a day. It's fallen off. It's roughly 10.5 million barrels a day due to that lack of demand. Similarly, a source of crude oil besides production are the imports. And we see that the imports have actually been growing a bit so that they're up from previous years' time. And what we can also do, since we have what we call noisy data here, we can smooth this by clicking on this 4-week period smoothing tab. And we have smoothed the data. And again, we see that while the imports are not as great as they were previous years, we are getting up there, so we have more coming in as a result of that. Now the demand for the, besides we have to look at the production and then look at the demand for the crude oil, and we do that by looking at crude oil runs, which is the input in the refineries, the crude slates that they're using to produce the refined products of gasoline, distillate, jet fuel, and so on. And we see, again, at the early April, runs dropped off dramatically for lack of demand. It's coming back a little bit, but yet relative to previous years, it's at very low levels. And we just make a one point here, back in 2017, that drop in the crude runs, it's not a bad data point, but it has to do with the hurricanes in the Gulf of Mexico, which flooded the refineries, and they couldn't operate, so the runs dropped dramatically at that point and then came back. If we look at the runs in terms of a time series perspective, again, we see relative to previous years, we've really fallen off and are working our way back. So that the demand for the crude oil, domestic demand, and this is reflected in other countries in China, has come off, but it is working its way back up as more, there is more opening of economic operations. And then in terms of the operable capacity by the refiners, we see that the actual capacity ability has been ratcheting up over the years, despite the fact in the U.S. there hasn't been a new refinery built since over 1975, I believe, was the last time. So relative to that and percent utilization, we see that the percent utilization is down to about 75%, has come back from 68%, but normally this time of the year, utilization is around 95%. And again, because of the lack of demand, we have lower utilization rates. And again, I can look at this from a time series perspective when clicking on this. And again, we see that the utilization has fallen off, but is working its way back. The other demand side for crude oil is our exports. And if I click here on the tab for crude exports as a time series, we see that it is also fallen off. We see that back in prior to 2014-15, where we had the laws that did not allow domestic crude oil production to be exported, that was changed, and the exports were growing dramatically. Let's get that back here, please. And so we see that the exports have fallen off. Let me just adjust this one more time. So the exports have fallen off. So that's another demand side, which has dropped, and that explains the huge, again, inventory levels we have. Now, since there is the lack of demand for gasoline production has also been down, has come back dramatically lower at the beginning of April. It's working its way back. And from a time series perspective, we see that it's coming back, but still relative to previous years, quite low. And if we turn in terms of, if we adjust this production number in terms of yield, that is relative to how much crude we're running, we see that the yield has actually worked its way back up relative to the fact that the low production low runs so that the yield is about normal. Similarly, the supply of distillates from a production perspective, curiously, has gone down relative to previous years. And again, from a time series perspective, we see it this way. And the reason for the production numbers to come off again is the low demand for the distillates. Excuse me, this was your, I wanted to do distillate demand. Here, let's see, that's what I wanted. The low demand there. It's again come back, but the low demand, low production has the impact of having oversupply of distillates. Going back to the gasoline demand side, we see the demand has fallen off. It's coming back a bit. And again, we see from a time series perspective. If we want to adjust that relative to the amount of crude oil that we have, what we call the days forward supply, we see that the days forward supply had peaked, came up, is coming off because we had much more supply than we needed at this time. So these are kind of the major supply-demand features we're seeing. In summary, because we're oversupplied in gasoline stocks, we are oversupplied in distillate stocks, we don't need them, we're reducing the runs, we're reducing production, but we still, because of lack of demand, we're seeing this go. In turn, we have overabundance of crude at this point relative to previous years. Actually, on a historic basis, if we can look at the time series, we're at record levels of inventories, which are depressing prices. And that would be the next thing we should look at relative to these supply-demand numbers, is how the impact is having on prices. So if I go to the price tab of our platform and bring up crude oil, and we can first look at it from a classic high-low close chart. And we see with using a candlestick chart, we see that the prices have, prior to this were over $60. I should back up a little bit further. And we've been coming off, and this one tab is that fateful day on Monday, April 20th, when crude prices actually went negative just before the expiration of the main contract. Now, prices have rallied about $20 from 20 to 40 at this point. But again, it's unclear whether they'll be able to sustain that level of price given the oversupply and the questions about the impact going forward of the demand for crude oil relative to the COVID-19 impact on demand issues for oil. Then if I want also to look at this from the perspective, what do I do here? Let's go. From the perspective of the forward curve of prices, we see that the market still is in contango relative to the low price because of the low prices, and it's flattening out somewhat, but it certainly has not become backwardated. What we can do is actually compare now where the curve was on prices by adding a position for looking at the WTI. And let's say we wanted to go back 2 weeks earlier to compare it, the forward curve at that time. And we see is this, we've raised in prices, we're flattening out a little bit, and I can compare this on a structural basis as a cumulative return. And we see that as of yesterday, the red line, we have flattened out a bit compared to the yellow line, which was 2 weeks ago, which shows a steeper form of contango. So at this point, we are seeing a flattening out. It'll be a while before it snaps back into a backwardated market, but at least we can compare how that curve is impacting the crude price. So let's talk directly about prices, what we call instruments and spreads. And I'll switch to the August contract for crude prices because the July is about to expire. And here our default is 10 years worth of price data. The current August contract for 2020 is sitting here in the white line. We have the forwards, the 2021 prices, 2022 and 23. I can highlight them, but also remove them from the screen by a left click, which takes them out. And we're looking at the current August contract, again at some of the lowest prices historically coming into expiration at this point. Now, little navigation feature we have, I'm holding down the control key on my keyboard, and then I left click on the 2020 data, and that just brings up that exclusively. And then I could back in previous years as I like if I wanted to compare specific previous years, say 2015 with these. So you can do that kind of navigation. Now, a major contract is sort of a measure of crude oil is the December contract. So I just switch months to December, plot that data. And we have this, again, similar fashion, the December contract for the crude oil, where we're sitting here. I want to make a couple of comments about this. While our system is heavily oriented to graphics, bringing up data quickly and easy to see it in graphical form, for users who want to see the actual numbers, we have this data button, which shows the values. I'll reverse the order here. With the recent settles, expiration date, and values, and so on. So you can tab back and forth between the actual prices, or if you wanted to export these to an Excel spreadsheet, you always have that option. Going back to the chart with the December contract. Another point I want to make here is if I wanted to kind of focus the data from June to expiration, I'm putting the mouse here, I'm holding it down and clicking on it, and then sweeping over. Oh, let me try to zoom out again. A little trouble with this mouse. So I highlight the data that I want to focus on. It's showing me now prices for the December contract, historically starting in June, going to expiration. And then what we can do is compare how that price moves with what we call absolute change. And so what that does, by setting it this way, it sets the price at zero, so to speak, as of June 1st, and then shows the change from June 1st into expiration. So if people are interested in trading or trying to understand price movement and volatility, this shows you how the price of the December contract either went up or down or stayed in some particular level relative to expiration. And so here, let's see, back in 2011, prices dropped dramatically in the DEES contract into October and then pulled back up and so on. So you get kind of a high-low range, a cone of prices, which gives you a sense of risk-reward if you're thinking that prices are going up or going down correspondingly. Now, let me go back for a moment and unwind this. Bring back the parameters. And what like I did before, I'm going to add another position And a common way of understanding the strength of the contango or the backwardation is to look at the DEES contract relative to next year's DEES contract, which we call the red months. Red months are 1 year out, 2 months are 2 years out. So if I do the spread, the difference between these two contracts, by the subtraction, so now I have what the classically called is the DEES red DEES crude oil spread. So again, this is a kind of measure of the backwardation, the contango in the crude market, focusing here on the current one. So we're looking right now that given the level of the contango, the back months are running about $2.50 above current December. It's basically kind of a measure of the steepness of the curve from December to December. And like before, if I wanted to compare this on a relative basis from June, I take the mouse, say put it up here, highlight the data that I want to focus on, let it go, and then do the absolute change. So we see that the DEES red DEES spread in several years has gotten more negative. Only 1 year, so to speak, in 2013, did the spread actually increase where the front of the market was higher than the back of the market. That was a backwardated contract at that time. So we can look at these spreads and ways of computing them in this fashion. Now, we should also compare then with the crude oil. We should compare the prices on the gasoline, for example, the refined products from the crude oil. And I pick the gasoline. Again, I'll go to the NYMEX contract and look at the August contract. I'll remove this leg and plot the data. So similarly to the crude, take out the forwards. And similarly to as gasoline prices go in tandem basically with the crude oil prices, we see the collapse in March into April, and it's coming back a bit. But at one point, gasoline, this is with the August contract, was actually less than 75 cents a gallon at that point. Now, in terms of understanding how this is related to crude, we would look at what we call the crack spread. So I'll add a position here. Switch to crude oil, WTI, and I want the August contract. Do the subtraction. The one other adjustment we need to make is that gasoline is priced in dollars per gallon. We have to adjust that to dollars per barrel, so we do a multiplication by 42 gallons in a barrel. So again, along with the crude, what this crack spread chart shows us is back in March when crude was collapsing, gasoline was collapsing faster, so that the crack spread went from roughly $18 to $20 a barrel to dropping to less than zero. It was actually negative crack spread at the end of March. It has come back a bit to $10 roughly, $11 a barrel, but that certainly is not a profitable margin for the refiners. So while in this case, while the crude has been working its way back up, gasoline has been moving up faster than that, and the crack spread has been increasing as a result. And I should just add that we can also look at this in terms of month-to-month spreads. Let me do, and so let's look at the August versus the September contract for gasoline. And so this would be your front-to-back spread for the gasoline as a simple example. So again, the August SEP spread took a major hit. Again, with the change has been coming back and has a ways to go before it becomes positive historically like it has done before. All right, I want to add here another position. And let's compare now also how heating oil, the distillate, has been behaving during this period when the crude prices have been so low through lack of demand. I'll take out a second leg for the moment. And we'll look again at the August contract. Similar fashion with the crude. Take out the forwards. And again, we're seeing the low level of price ratcheting its way up. And then we would want to adjust that relative to the crude, looking at the crack spread. Switching to crude oil. The August contract. Do the subtraction. Multiply by 42. And look at the heat crack. And I'll take out the forwards. And again, in this case, the heating oil crack did worse than the gasoline crack, again, because of the oversupply, the lack of demand. And we're seeing here that it actually had gotten to under $10 a barrel. It's working its way back. But again, from a refiner's margin perspective, this is a very weak crack spread. Now, it's often thought of as a winter fuel. We could compare it on, say, the December contracts. And again, from this December contract crack spread, it's equally as weak, with only a few occasions where it was lower into this period. Now, we could talk about this in terms of a refiner's margin, where I could add another leg. And in our system, there's no limit to the number of legs that could be created in a combination of contracts. But if I wanted to look at say, a refiner's margin, say a 3-2-1, excuse me, where the relationship between the gasoline and heating oil is 2-to-1 basis. And what we would do, instead of using 42, we would split this into 14 and 28, so that the gasoline ratio is 2-to-1 to the heating oil, which is not unusual. And I can keep it with the December contract refiner's margin of 321. So again, with this, even from a refiner's margin where we're weighting the gasoline with the heating oil, the crack spread as a 321 is less than $10, which is again very unprofitable for the refiners at this point. All right. Now we can look at prices, and we had looked at fundamentals and all the supply-demand issues in the fundamentals and the reflecting in the prices. What we can also do in our system, what we mean by analysis, is the merging of prices with fundamental data. It's not technical analysis, but it means the merging of the fundamental data against price data. So if I wanted to look at what we call a time series of that, I'll switch to continuation, and we'll talk about crude oil price for the moment. As far as the fundamental data, we'll use the DOE numbers, crude oil, look at stocks as we had looked before. And now we plot these. And I'll squeeze back the scale because we have more price data than fundamental data relative to this. And no surprise that we see an inverse relation between stocks using the right axis and price using the left axis. And we see this inverse relation when stocks are falling, prices are rising, and conversely. And so we've had this huge overlay, additional crude oil inventories, which we had this crazy movement there, but then it's pulled back, but still relative to the price that we've been at, we're still at very low levels. Now we can compare that in another fashion. Instead of from a time series perspective, we could look at it from a classic scatter plot. Again, crude oil, stocks. I could pick any fundamental data against price, but I'm just doing stocks for a discussion example. And so we see a relative inverse relation. We add a regression line to it. We can run it like this way. I should add one other piece with this. Go back to fundamental data. Besides supply-demand numbers from the DOE, we like to look at the commitment of traders numbers as a kind of measure of the funds and what they're looking at in terms of crude pricing. So I go to crude oil, and we'll use the CFTC light sweet, NYMEX. And if I look at total open interest, So here's, again, a year-on-year overlay of the total open interest for the crude oil contract. From a time series perspective, we see that we had peaked back in 2019 when prices were higher, and back in 2018 when they were higher yet. Now, what I'd like to do with that is go back to the analysis, do the time series again. And in this case, rather than total open interest, we picked before the total open interest, I'm going to use the non-commercial longs. So these are the hedge funds in their long position. I'll duplicate that and do the non-commercial shorts. And so by taking the difference between these two, I get the net position, the longs minus the shorts of the funds, the non-commercials, in crude oil. I'll squeeze this back. And no surprise that the fund's net position tends to track the price of crude. Again, the right side is the fund's net position, the left side is the crude price, and we see them so that the funds can move in their following tracking of crude oil prices. They can actually be a momentum follower and cause prices to move higher or lower than one would expect as the funds get in and out of the market this way. Now you see we've created a whole series of charts with data and information, which we call a dashboard. Just to comment, any one of these charts that one might be looking at on a regular basis can then save them as a time series. Excuse me, as in a library. If I click on Save, here's my analysis of the price of crude relative to the fund's net position, and I could save it, and again have it on default show, and it comes up. So we could have a whole collection in a library of all these tabs, and can be brought up individually or as a group on logging into the website. So what I wanted to cover this afternoon, is the supply-demand numbers having to do with the EIA and so on over this recent data update that came this morning relative to price behavior. So one can examine supply-demand numbers and look at the corresponding price of the appropriate contracts as looking for the relationship or understanding what we would call the bias from the supply-demand information where we think prices may be moving. And that pretty much covers it at this point. I'll take some questions.
Okay, everyone, I would like to remind you, if you do have questions for Joel at this point, you'll find a questions title bar included in the control panel on the right-hand side of your screen. Simply double-click there and you can add any of your questions at this point that you may have for Joel. Now, while he's reading through the questions that come in, I'd also like to take a moment and show you that Okay, now you should be able to hear me speaking. Okay, coming in much better. Sorry about that. All right, now, while we are waiting for any additional questions that you might have, what I do want to do is move over. I'm going to be grab the controls for just a moment, and let's take you into the Trader Workstation platform. So let me pull that up, and I'm going to actually show my screen here. Now notice that I do have the Trader Workstation open. Now we do have Fundamental Analytics has been seamlessly integrated into the trading platform. You can access that information by simply going to the New Window button and going in here to the Analyst Research, where you will find Fundamental Analytics. Now, notice here that it is available. Now, if you have not subscribed, what I'm going to do is take you to the Interactive Brokers webpage, where you can access the information underneath the pricing menu. Notice that if you go to Research and News, it'll open up a separate page where you can find the Fundamental Analytics listing. I think I've already pulled that up, so I'm going to go in here, and you'll see that listed on that page is Fundamental Analytics with two different pricing structures here for individuals as well as for corporate. Now, I do want to mention that we also provide a 30-day free trial period. So if you're interested in trying out the Fundamental Analytics platform, notice here, if you scroll to the very bottom of your screen, there is a Learn More button. Now, I do want to mention, notice here that it is a third-party tool. So once you do subscribe, you'll find that it is available or on a website that Joel was mentioning. Notice if I click through on that Learn More button, you can view those sample reports and even access the website directly from this window. Now also, if you do want to subscribe, let me take you back into the Trader Workstation and notice here from that New Window button, when we go into Analyst Research, you'll find let me go into Fundamental Analytics. Simply double click. If you haven't subscribed yet, you'll find this window pops up, and notice that by going into that subscribe button, it will take you into your portal. This portal is where you'll be able to make those subscription choices. Now keep in mind, there is a one-time free trial period that will apply the very first time that you subscribe. It is a one-time free trial and will expire 30 days after you do subscribe to that information. At that point, if you do want to continue the subscription, you'll be able to do that through this window as well. So a quick look on how you can access the information, even view, and let's go back a page here. Notice that you can even get access to the website and view a sample report as well. So with that, I'm going to take it back over to you, Joel. Let me make you the presenter, and we'll see if there are questions that have come in. If you would, go ahead and share your screen once again, and we'll tackle those questions at this point.
Thank you, Cynthia. Okay, a couple of quick questions that came up sort of during my demonstration, which I've already answered, was, is there a limit to the number of legs that one would set up in a particular chart? And the answer is no. You can use as many as you wish and have as many legs in the construction of this. There was also a question, is there a limit to the number of tabs? And the answer is no. I don't know how many tabs I've got here, 20, 25. We've had clients who will have over 30 tabs open at a given time, and they're all automatically refreshing when they go to the tabs. There was also a question about hard copy. If there's a way of printing out these charts on a hard copy. And there is, yes. Over here, there's a little tab for chart context menus, and if I wanted, say, to print a chart as a JPEG to put into a document that I'm writing, and I wanted to include that, we set that up, we click on that, and open it up, and it shows you what it would look like as a JPEG hard copy that you could then insert and edit and so on. And so those were the few questions that came up. I can answer any others that might be, but that's what I've seen here, Cynthia.
Okay. Well, thank you very much, Joel. Great presentation here this afternoon. By the way, I also do want to point out we do have some slides available in the handouts pane that will go back and go through the different keystrokes that Joel was using to access this information on the Fundamental Analytics website. So with that, we are going to conclude our session today. By the way, we have been recording today's event, and each of you will get a direct link to today's recorded playback soon after this session ends. So if you do want to come back and review what Joel was describing and access the Fundamental Analytics page as well, simply watch your inbox later on today for a direct link to today's recorded playback. By the way, this will also be listed on the Interactive Brokers website. So watch your inbox for today's follow-up messages, and thank you all for attending here today. By the way, great deal of thanks to Joel Fingerman for our presentation and Fundamental Analytics. So with that, have a great day, everyone. You can exit the platform using the X in the upper right-hand corner of your screen. Have a good one all, and thank you.